In the wake of Silicon Valley Bank's sudden collapse last year, savvy investors wasted no time positioning themselves for potential windfalls based on a hastily released government press statement. However, what followed was a legal saga that has placed the Federal Deposit Insurance Corps, FDIC, in the spotlight, facing a critical court ruling that could compel the regulator to provide transparency regarding the formulation of an announcement that could potentially expose it to a staggering $2 billion payout from its primary insurance fund, the total of which is based on premium deposits. It's interesting to note that First Citizens Bancshares, SVB's parent company, filed their quarterly report on April 25, 2024, and reported a net income for the first quarter of 2024 of $731 million, compared to $514 million for the fourth quarter of 2023. The net income available to their stockholders was $716 million instead of $499 million the last quarter of 2023. So even with their alleged $2 billion loss, they still made $731 million in one quarter alone. Is it just me, or does this define the deadly sin of greed? This substantial sum would not only benefit the bankrupt parent company of the failed bank, SVB Financial Group, but would also have significant ramifications for other major U.S. banks, potentially impacting their financial stability. In a nutshell, Silicon Valley Bank and their parent company, First Citizens Bancshares, and all of their top executives will get $2 billion, given priority over the little guy who had their life savings on deposit with the Silicon Valley Bank and any other banks who may go bankrupt. This is not unusual. We've seen this before. Everybody has their hands on your money before you do. At the heart of this legal dispute lies the FDIC's emergency declaration in March, promising to compensate all depositors of the institution, irrespective of their insurance status. Notably, SVB's parent company emerged as one of the primary beneficiaries of this declaration, given the drastic decline in the value of its stocks and bonds following the bank's collapse. However, despite the potential for significant gains for certain creditors, the FDIC has staunchly contested the payout, leading to an escalating legal battle. As demands mount for the FDIC to disclose internal documents detailing its decision-making process, the case has raised significant political implications. Simultaneously, the regulator is vigorously attempting to have the case dismissed, underscoring the high stakes involved. This case outlines the unknown risks to money on deposit with banks, even if they are FDIC insured. The FDIC is owned and operated by the federal government and is funded by premiums paid by member banks, so if these premiums go down, so does the money to pay people who lose their deposits from bank failures. The FDIC website reported that their premium income was down $30 billion in just the first quarter of 2024. Against the backdrop of this legal turmoil, the FDIC's reputation has come under scrutiny, with critics highlighting supervisory oversights and concerns regarding its workplace culture. This marks a notable departure from the agency's perceived image in the aftermath of the 2008 financial crisis, when it garnered praise for its adept handling of bank failures. Moreover, the fallout from Silicon Valley Bank's collapse sheds light on broader systemic issues within the banking sector, revealing the intricate dynamics between regulatory bodies and financial institutions during times of crisis. As the legal proceedings unfold, stakeholders are closely watching the outcome, which could have far-reaching implications for the banking industry's regulatory landscape and investor confidence in the FDIC's ability to safeguard the financial system.